Investment strategies and stock picks. I'm joined now by Tom Hayes, chairman and managing member, Great Hill Capital. Tom, thank you so much for joining us today. Before we get into your picks and strategies, let's talk a little bit about the recovery, because you have some thoughts on this, a V-shaped recovery that we've seen. You say overbought can stay overbought. What do you mean by that?
Yeah, I've been doing this for a while, as you know, Diane, and what I've found is when you get these sharp V-shaped recoveries, the normal signals that you would get when we're in a regular range, when it gets overbought, you want to lighten up a little bit, they don't apply when you come 25% off the lows in 3 months. And actually what happens historically, if you look back to 1950, on average, when the market's up 25% in 3 months, on average, the market goes up another 22.3% the next 12 months. That sounds crazy with the market trading at 22, 23 times earnings. But you got to be open-minded. Should we get some consolidation after such a big move? Yeah, we might get some sideways. We might get a little chop. But I wouldn't underestimate, because it's what we call trapped bears, and a lot of people, not so much retail. The retail investors have been the smart ones.
They do say that the retail investors were the smart money this time around.
Yeah, since COVID, actually, every single dip. Institutions are still behind the curve. They're still skeptical, and now they've got career risk because they lightened up at the exact wrong time. They sold over $1 trillion of equity in the hole, and every new good headline, whether it's a deal, whether it's earnings coming in better than expectations, they are forced back in. And you know what? They're going to be forced in. They can't chase the stuff that already ran. They miss that. They have to chase the laggards that are playing the catch-up trade in order to have any chance of catching the indices.
So I'll talk a little bit more about that. So then, what makes it, you said if you go back to 1950, what makes this setup different than a typical late-stage rally?
Yeah, I think you have a lot of pro-business policy that has just been implemented. So we went from bombing and tariffs and uncertainty to now tax cuts, growth, and we haven't even gotten to the biggest part of it, which is going to be massive deregulation, okay? Unleashing animal spirits. You have corporate balance sheets of the S&P 500, the most under-levered they've been in years, and personal household balance sheets, the most under-levered they've been in years. So what's gumming up the system? Why don't we have animal spirits and 3.5%, 4% GDP growth? We have artificially high interest rates. Okay, there was a Fed head on 2 days ago saying we're around the neutral rate. Listen, I have an 11-year-old daughter in 5th grade. I can say to her, the Fed funds rate is 4.25%. Inflation is 2.7%. Does that look neutral to you? And she would say, no, Daddy, it looks like you could drive a truck through that. The gap is so big.
She would say that for an 11-year-old. Okay, maybe in your household. So you're making the case that the laggards will need to play catch up. Yeah. Where do you see opportunity within sectors or names when it comes to the laggards?
Okay, so one we brought to you when everyone was scared in April, and that was called Advanced Auto Parts. You couldn't give this thing away. It got down to $30. Everyone thought it was going out of business.
Yeah. In May, oh my gosh, it was terrible.
Okay. So, number one, it's doubled off the bottoms. Number two, it's going to double again over the next couple of years.
Why?
Shane O'Kelly, he came from HD Supply. Okay, this is a $7 billion business for Home Depot. He understands distribution. So what did he do? He took solvency risk off the table. He sold off the Canada business, used that money, paid down debt. Now solvency is no longer an issue. Then he said, okay, the United States, the West Coast is doing terribly because the stores are all spread out. They don't have any critical mass. We're spending too much money. It's taking too long to get the products to the customers. We're just going to be a loser in that area. We're shutting down those stores. Then what did he do? Clean up, balance sheet good, clean up the unprofitable stores. Now he's back into growth mode. He's opening up 100 new stores in the next 3 years in those areas, only which he is number one or number two in the auto parts supply business, which is going to create efficiencies, which is going to create growth. And here's the kicker. He's going to have margins at high single digits within the next 24 to 36 months. The last time they had that, the stock was $150. It's $60-ish today, so that's why it's gone from 30 to 60. It's going to 120 over the next couple of years.
Okay, because I was going to ask you, if it's doubled, how much more growth could it have?
It'll consolidate the next few weeks, but if you take a 2-year view, it's going to double again.
Okay, all right. Take a 2-year view on that one from the point of view of Tom Hayes there. All right, Tom, let's talk about Canada Goose. That's on your list.
Yes.
It has outperformed the S&P 500 year to date now, and a chunk of that run came within the past month or so.
Yeah. Why
does it have more room to run from your point of view?
Here's the thing.
I mean, their coats are expensive.
Their coats are super expensive. So we like this in the high single digits and the low double digits. It's moved. However, it's still down 80-90% from its COVID highs. In the short term, the market is a voting machine based on emotion. In the long term, it's a weighing machine based on fundamentals. Let me tell you about these fundamentals. They have record revenues, record free cash flow, and now record margins. So why is the stock still down 90%? They're getting rid of their wholesale business, which is the lower margin business. They're all going DTC. The other thing is
people they're going DTC. Okay.
Oh yeah, 76 stores. You got the one on Fifth Avenue. You always see a line. But here's the kicker. Like all luxury brands, they go, oh, not everyone can afford a $1,900 or a $1,500 parka.
The low, yes.
They're going $365. Raincoats, eyewear, shoes, T-shirts.
Okay.
So everyone can afford a piece of the brand, and it's huge not only in Asia, it's huge all over the world. High quality stuff, family controlled. Family's got 39.5% of the stock. The son is running it. Danny is doing an incredible job. They're buying back stock. This is going to be a great recovery. It's amazing. This is my knitting. Okay, when fundamentals are improving but the price is depressed, you play that divergence, and eventually, short-term voting, long-term weighing, it will catch up to fundamentals. That's the story in Canada Goose. Does it pull back a couple bucks in the next? I have no idea, but over the next couple of years, this strategy is working. Margins are up. More and more people can afford their products. It's not just jackets.
Because they're expanding. Quick 30-second final thought from you. I know you have another pick. You can either go there or a final thought on the overall market.
I think, well, National Oil Well Varco is the old name. NOV Inc. I love stocks. What can I say?
That's all right.
All right. They've got 50% of the market. They do onshore and offshore drilling rigs. They're the largest OEM, and they have an install base bigger than anyone else, which helps them with the cyclicality of the price. They're less sensitive to price. I want exposure to energy. I don't feel like the exploration and production companies have come down enough relative to the price of oil. So this is a way to play it. It's the cheapest it's been since 2001, right before it had a 10x run. The balance sheet is great, $1 billion of cash, just over $1 billion of debt, $1 billion of free cash flow. They're not issuing shares, they're non-dilutive. So if you think drilling is going to go up, which it will when rates come down, they're going to be a major beneficiary, and its operating leverage is huge. So that's a new one for us. We like it, and
all right, that's a new one. You heard this here first. Well, I think first. We'll see.
Ish.
Ish. I mean, Tom is active on social media, so you can find more information there as well. That's Tom Hayes joining us right now here on set at the New York Stock Exchange, chairman of Great Hill Capital.